Hello and welcome to Market Watch for the start of a new week, the 29th of January 2018, and it is a big week at that. There is so much information coming out this week, and that goes with next week as well, when it's basically the first week back for central bankers across the world, and we'll get our first RBA meeting for 2018. It is also looking at some other admin stuff. Technically the start of Australia's half-year earnings season. There are some giving you full as well. So this week sees the start of that. There's 3 companies, but next week it starts in earnest. And again, there's going to be a lot of data flying at you. So just keep that in mind. Try and keep it as simple as you can as you go through and look through some of the headline stuff and get down to the stuff that really matters. So with that, let's move into what's pretty much going to be a very interesting week. There's a few pieces out from Europe, and I'll quickly highlight them. As I spoke about last week and the week before, you are now getting to a point where Europe is being shown as possibly the growth market of 2018. It's the last one, the last global player in the whole market to really catch up, and their growth GDP is due out this week along with their inflation numbers. Now, the reason I highlight that is that in the last minutes from December last year, Mario Draghi did highlight that they may think about moving monetary policy on the caveat that certain market conditions came about, and they are inflation and growth. So this week, keep an eye on that. That's certainly going to move things around. The reason it's important to us is that the nation that will soak up the global growth story is China. And we did see that at the end of last year. China actually saw their GDP move up for the first time in 3 years. It went from 6.7% GDP growth in 2016 to 6.9% in 2017, and expected to do the same thing this year. That's a positive for us as well, and you can see that in the demand that they have had for our bulk commodities. And there's a few charts that I've got here on screen for you that show iron ore over the year. From Westpac, it's a really good sort of idea of what's happened in the iron ore space and why we've had a really good drive in our net exports on our GDP side. And we will pick up the benefit with regards to moving in that space off the back of a European growth story, off the back of a China picking up the slack story, the US continuing the way it is. So keep an eye on that. The US is also out there. This week is the last meeting for Janet Yellen. Now, unfortunately, it's not a press conference meeting, so she will not speak. Don't expect any movements in the Fed funds rate. They normally only do that with a press conference meeting so they can actually explain their reasoning. But just watch the statements, and particularly the minutes in about 3 to 4 weeks' time, about whether or not she signs off on her period as chair. I think she's been fantastic. It is a little bit sad to see her go. But in saying that, she's had a very interesting sort of scenario that she's come through. She picked up from Ben Bernanke, where QE was still going relatively strongly. It was starting to ease off, but she had to pick up that period, still have QE, and she's then gone through a period where she's actually gone through what we call QT, so quantitative tightening. And it's been an interesting sort of conundrum for her to juggle, the communication that she's had to put out there. So it will always move markets, what happens with the Fed, but it won't be as big as normal, but just keep that on your radar. And then let's bring to what we really need to concentrate from an Australian-centric point of view. In the end, despite all the talk you hear about our growth, about our housing market, about employment markets, about what our government is doing on either sides of the political divide, you've got to remember monetary policy has one mandate in this country, and that's making sure that inflation, and that's the trim mean inflation, sits between 2 and 3%. So this is the chart that I've put up for you a couple of times. It very clearly shows you that band in that little blue coloured shading and how far away we are from that figure. So having a look at where we were at the end of the last quarter, trim mean inflation sitting at 1.8% year on year. If you have a look at seasonally adjusted CPI, it's still not near that either. It did flick into it very quickly in the September quarter and then dropped out. We have not crossed into this band for almost 2 years. And if the RBA is going to move rates because inflation's starting to run away, realistically it should be sitting around 2.5%, or at least heading to that direction very, very quickly. And it's just not. And this gets back down to what some people might talk to you about around whether or not we follow global banks and global central banks in raising rates. Again, the mandate of the RBA is to maintain and monitor our economy on a domestic level. Domestically, growth is reasonable. It's not great, but it's reasonable. Inflation isn't materializing. You've got a very big push-pull between whether or not we're optimistic or pessimistic. Also, consumption has been quite sporadic and definitely gets knocked around by any form of headline news that could make it negative. And that's why the RBA, in my opinion anyway, is unlikely to move again in 2018. And it doesn't need to. Things are quite nicely balanced if you look at this. So CPI on Thursday is absolutely key to your understanding about domestically where we sit and what the RBA will do. And that's why it's probably the key data you need to have is basically your macro theme from a domestic level.